Fear hits 27. Wall Street calls NVIDIA overbought. The engineering reality is Hopper's structural transformer dominance. We're running the numbers, and one call might surprise you. By NVIDIA at 66 lab score. Their Hopper architecture delivers 2.5x higher transformer model throughput than AMD's MI300X, confirmed in MLPerf benchmarks. This die-level optimization drives 78% data center gross margins. The real story isn't AI hype. It's silicon geometry and memory bandwidth engineered to exploit transformer sparsity. The teardown reveals supply chain control few can match. NVIDIA's dominance is no longer about software modes. It is a brutal war of physical dimensions where the Blackwell B200's 800 mm superscript 2 die size, the physical area of the silicon chip, hits the absolute reticle limit. The maximum size a single chip can be printed by lithography machines. To bypass this physical wall, NVIDIA is deploying a 10 terabytes per second NVLink interconnect, the specialized high-speed bus that allows two separate chips to communicate as one, to fuse two dies into a single 208 billion transistor monster. While the AMD MI350X attempts to compete on raw HBM3E capacity, high-bandwidth memory 3rd Gen extended, the ultra-fast RAM used for AI, it lacks NVIDIA's CoWSL packaging yield. CoWSL is the advanced stacking technique that uses a silicon bridge to connect dies. At a $5.5t market cap, NVIDIA is betting everything on these interconnects because single chip scaling has officially died. The lab is tracking a critical shift in Blackwell's TDP, thermal design power. The maximum heat a chip is rated to dissipate, which has now reached 1,200 watts per GPU. This thermal wall is why Elon Musk's $119 billion terafab project is mandatory. You cannot run these chips on air cooling at scale. We are seeing Blackwell's HBM3E bandwidth hit 8 terabytes per second, a 33% jump over the previous Hopper architecture, which justifies the 2.12% move to $225.28 as the market anticipates a massive earnings beat. Wall Street is focused on the $215.94 billion annual revenue, but the real alpha is in the CoWSL yield percentages at TSMC, Taiwan's semiconductor manufacturing company, the world's leading foundry. If those yields stay above 90%, NVIDIA's gross margins will crush the 75% consensus. Today's rally proves the market finally realizes that in AI 2.0, silicon physics dictates the balance sheet. Quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA is currently a 73.2% revenue growth engine, outrunning a 4.61% cost of capital, making it the primary sanctuary from looming trade war tariffs. While the Dow slips ahead of Fed minutes, the lab sees a structural divergence. The yield curve is finally normalizing, the process where long-term interest rates rise above short-term rates to reflect a healthy economy. This normalization, paired with a 10-year yield of 4.61%, the interest rate the U.S. government pays to borrow for a decade, usually strangles high-multiple tech. But with CPI, Consumer Price Index, a measure of inflation, sitting at a cool 0.6% year-over-year, NVIDIA's 95.6% EPS growth. Earnings per share, the portion of profit allocated to each outstanding share, acts as a kinetic shield. We are watching the Fed closely as Kevin Warsh faces pressure from bond vigilantes, investors who sell bonds to protest inflationary policies, to hike rates in July. The macro tension is shifting from interest rates to the physical borders of trade. Global markets are stumbling as new Trump tariffs, taxes on imported goods, ignite fears of a renewed trade war over Greenland and China. While analysts cry geopolitical uncertainty, the lab tracks the specific friction. Trade barriers act as attacks on the global silicon supply chain. However, NVIDIA's 2.24 beta, a measure of a stock's volatility relative to the S&P 500, suggests it is the high-velocity vehicle of choice for capital fleeing stagnant sectors. Despite a 4.3% unemployment rate signaling a softening labor market, the AI score of 66 out of 100 proves the structural shift toward automation is accelerating. We are witnessing a dispersion phase where software moats evaporate, but NVIDIA's hardware remains the only bridge across the geopolitical chasm. The narrative isn't about a volatile market. It is about who owns the infrastructure that survives the tariff wall. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. NVIDIA is trending higher, currently at $225.28. NVIDIA's earnings hype machine is running at full tilt. Management is out there selling the same story. AI demand is insatiable, supply chain is bulletproof, and every GPU we ship prints margin. But let's talk about the 911,732 shares insiders just dumped in the last 90 days. That's not a trickle, that's a fire hose. When executives sell this aggressively, it's not about diversification, it's about valuation. They see the multiple expansion as temporary, and they're cashing out while the street still believes the narrative. Historically, this pattern precedes a margin squeeze or a demand air pocket, exactly what the glossy press releases won't tell you. The EPS beat of 3.6% looks solid on paper, but dig into the R&D spend. $18.5 billion, up 43% year over year. That's not efficiency, that's desperation. NVIDIA is burning cash to stay ahead of Blackwell yield curves and CoWoS packaging bottlenecks, and the street is treating it like CAPEX, not OPEX. Meanwhile, the 8K language is suddenly littered with SEC boilerplate about forward-looking statements, a classic tell that management is bracing for a miss they can later blame on macro conditions. What they're really saying, we're maxing out TSMC's 3 nanometers capacity, and if Blackwell underperforms, we've got no plan B. The lab hears this. NVIDIA's PR is a margin call in disguise. The risk factors they're not mentioning? Yield degradation and HBM3E bandwidth saturation, 2 words that could crater gross margins in Q3. The momentum breakdown for NVIDIA. RSI sits at 70, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above 0. NVIDIA's dominance is anchored by the Hopper architecture, the GPU design optimized for the transformer models that power modern AI. By leveraging EUV lithography, extreme ultraviolet light used to etch patterns on silicon at the 5-nanometer scale, NVIDIA has maintained a performance moat that competitors cannot bridge with software alone. With a forward P/E of 19.4x, the market is betting heavily on the GH100 to sustain this lead through advanced packaging. But here is what breaks the bull thesis. Inventory corrections at hyperscalers like Amazon and Microsoft. While the RSI sits at 70.7, indicating the stock is nearing overbought territory, the physical supply chain remains vulnerable to the US-China tech war. Export controls on H100 chips to Baidu and Tencent aren't just political noise. They're direct hits to the revenue ceiling that even the CHIPS Act cannot immediately offset. The question that makes the boardroom go silent is this: can NVIDIA maintain its 46.0x trailing P/E if data center growth plateaus before the RTX 5080 launch? Our answer is no. While the MACD, Moving Average Convergence Divergence, a momentum indicator that tracks the relationship between 2 moving averages, shows a bullish crossover, the volume is 7.9% below the 20-day average. This suggests the current move lacks the institutional conviction required to shatter the $235.74 resistance level. The lab's AI score of 66 reflects a stock that is technically overextended but fundamentally sound. Watch the $196.50 support level. If it fails, the technical setup collapses regardless of the AI hype. NVIDIA is a hold until the next generation GPU proves it can offset the looming data center slowdown. NVIDIA's Blackwell die yield just hit 68%. That's the margin signal no one's talking about. Wall Street sees a stock, we see silicon. If yields keep climbing, this isn't a rally, it's a reset. Here's the debate. Is NVDA's 66-point buy call the last safe entry before the next leg up, or are we ignoring a looming supply glut? Drop your take, bull or bear, right now. Remember, this isn't financial advice. The lab breaks down the engineering, but markets move on more than data. Do your own research, trade your own plan, and never risk more than you can afford to lose. We'll see you in the next breakdown. Stay sharp.